Right. Hey, welcome to another video with me here, Nathan Garcia. I am doing a video for you here today to discuss 5 predictions for 2020 as I try to iron out all the details of the live streaming process to get the timing right and to make sure that I have control over everything. So I'm so happy to be with you here today and share some of my thoughts about where things are heading for retirees in 2020. And in this video, you're going to learn about 5 different things that retirees are going to have to consider in their retirement plan if they're looking at retiring in 2020. So we'll talk a little bit about some different pieces, some different things that we're watching in the market, and we'll also share some insights on different products and solutions that could be helpful for you if you're getting ready to retire this year. But before we move any forward, I wanted to let you know that I am hosting a training on an update on retirement planning that Congress passed last month. That's going to impact anybody who is retiring this year or in the future. It's the Congress passed a bill called the Secure Act, and that bill changes the way that you have to take required minimum distributions, how you can contribute to an IRA, and how you can pass money on to your loved ones after death. And so I have put together educational training for you to walk you through some of that information and then some of the impact that it might have on your retirement plan. So if you'd like to watch that training, I'll be hosting it live next Thursday on January 9th at 7 p.m. Eastern Time, and you can register for that at garciasecureact.com. So that's why you see that URL there at the bottom. But with that out of the way, let's talk about some predictions here for 2020. You know, I did this simply to start to put in place some of my thoughts so that I could go back and refer to it next year and kind of see where I was and where I maybe was wrong. So the first thing that we're going to talk about is the Federal Reserve and how they are monetizing their debt, or they started what we would call quantitative easing for. They won't tell you that, but what we are seeing in the financial markets is that they have been very accommodative for increasing their balance sheet, meaning that they are buying bonds and they are expanding their balance sheet. That's significant to you as a retiree because the Federal Reserve sets interest rates. And if they are going out and buying bonds, then that could have an impact on interest rates, and it might have an impact on what your options are for generating income in retirement. So you want to be aware of that. Now, what you see here is a slide of the S&P 500 with the assets of major central banks across the globe. This is provided by Yardeni Research. You can see their name there in the bottom right-hand corner. And this was just produced on January 2nd, so it's very current. This is a great resource for you. But basically what you can see in this chart is how, as the Federal Reserve has increased the size of their balance sheet, the S&P 500 has gone up. And that's significant as an investor because most investors want assurance that they at least are aware of the risk of investments before they put their money into them. And when you have the Federal Reserve and other central banks in the market, that is really distorting the risk and your ability to measure the risk. And so you want to be aware of that. And as you can see, there's definitely what I would say is a correlation between how much money the central banks are putting into the and how much money central banks have grown their balance sheets by, and how the performance of the stock market has played out. Now, this is most significant because we've seen the Federal Reserve has cut interest rates here in the U.S. In 2019. They did start to expand their balance sheet. And just recently, we've started to see some articles that are coming out that are alleging that not even alleging, they're showing all the pieces of how the Federal Reserve is buying these bonds from their market dealers. So what happens in the U.S. is the Treasury, the U.S. Treasury will issue a bond, and that bond is then purchased by a dealer, major bank like Goldman Sachs or Chase or Citi, and then the Federal Reserve is actually buying that bond from those banks at a premium. And so as an investor, you want to be aware of this for a few different reasons. First of all, many people have an issue with the direct monetization of debt because effectively you have a centrally planned economy, just like the USSR, when you start to get engaged in, the Fed, the government running the economy like that. And that doesn't sit well with many people. Second of all, it distorts the actual interest rates or the amount of or the yield that you should receive from bonds, because you have the Fed coming in and buying up these bonds. And so as a result, what we've seen is that retirees have to actually go into riskier assets like the S&P 500 in order to get a livable yield. And so that's pushing people into riskier investments like stocks and high yield bonds and causing them to look for yield there, which may not be great for their retirement plan. The other thing that is noticeable about this trend is that there's a lot of similarities to the performance of the Federal Reserve and the performance in the S&P 500. And so if the Federal Reserve says that they're not buying up bonds anymore, then there could be a pullback not only in the S&P 500, but there might be a sell-off in the bond market as well. I don't really know. There are too many factors at play here, but the overall point here and that I want to make in my prediction here for 2020 is that you are going to see the Federal Reserve continue to expand their balance sheet, and that is going to have a major impact on financial markets. So as an investor, you want to be aware of that, and of course, you want to take appropriate action there. So prediction number 2 for 2020 is I think that we will see some sort of market pullback. I don't know how much or when, but I do think that the U.S. and the global economy has been impacted by the uncertainty around the trade deal. I also believe that the expansion that we have seen since the financial crisis of 2008, 2009 is really long in the tooth. This is a chart pulled from Real Investment Advice. If you haven't visited their website, go check it out. They do some great articles and great research there. But what you see in this chart is the length of recovery. And as you'll notice, our current recovery is the longest in history since a market decline. And so what that tells you is that we are overdue for a market correction of some sort. Trees don't grow to the sky. And as a result of that, I would, as a retiree, be aware of that and say, well, if there is a market pullback here, how do I position myself to take advantage of that so that I can buy things when they're cheap? If you look at Warren Buffett, what some people would consider as one of the most successful investors in the world, he has been sitting on over $100 billion in cash because he's said that things are too expensive, and he's expected a market pullback for a while now. And so what he's done to position himself and his investors is actually to stockpile some cash so that he can take advantage of that buying opportunity when the market does pull back. So as a retiree, you want to consider, where are you getting into the market, and is there potential for a pullback? Some of the ways that we may see a pullback, or some of the reasons, the catalysts, could be the 2020 election, right? If Trump is reelected, that could be positive or negative. It's really hard to tell. It could also be the trade deal. If we get to a trade deal, you might see the market sell off because every time that the trade deal was mentioned last year, and I use every time as being dramatic, but it seemed like every time that you saw Trump or Kudlow or Mnuchin talk about the trade deal, the market was positive. And so there's a old adage of buy the rumor and sell the news. So the rumor in this case may be the U.S. and China are going to have a trade deal. The news might be that, hey, we actually got a trade deal done. And so when that occurs, you might see a sell-off there. It's hard to tell. And then finally, a potential war with Iran. That could obviously have a negative impact on the stock market. Not if you're holding Lockheed Martin stock like some of my clients are, because they either work for them now or worked for them in the past. If you need a preview or a little insight as to what war does for those companies, you need to go take a look at Lockheed Martin stock. It's just been on a tear over the past couple years, but it's something that you want to consider, is that maybe if we are expecting a war, what companies are going to benefit from that? Obviously, defense contractors would benefit, and then others would be hurt by it, right? You saw the price of oil shoot up today as a result of kind of the uncertainty around that. So you want to at least have some of these scenarios played out or factored into your investment portfolio. So we'll look at that going forward in 2020. Now, the third prediction that I have for 2020 is that you are going to see some volatility in the bond market. What you're looking at in the chart here is investment grade issuers, their debt to their earnings before interest, taxes, depreciation. Basically, what this is showing you is how much debt issuers have taken on and how much their earnings are. And effectively what it's saying is that the companies that have issued the most debt are actually most vulnerable to a downgrade in their credit rating if their revenue growth declines, if they're making less money, or if they're less profitable. And so as a result of that, what you may see is that there could be a sell-off in the bond market. It could hit high yield bonds. It could hit a number of different places, but we're watching the corporate bond market closely, because there's a lot of debt that needs to be refinanced over the next couple years. And if there's a slowdown, if there's a sell-off in stocks, or if there's a slowdown in revenue growth, you might see an impact on the bonds themselves. And so I think that that's something to keep an eye on for retirees, because traditionally retirees go into bonds as a safe investment. And nowadays, with those factors at play, that may not be the best choice. So what could be a catalyst for some bond market volatility? Well, you might see decreasing revenue growth or profit margins, like I mentioned. You might see a weaker dollar. If we continue to escalate the situation in Iran, you might see some companies or some countries shy away from the dollar. Opposite is true as well. But look, as a country, we're running about $1 trillion deficit, meaning that we're spending about $1 trillion more than what we're bringing in. At some point, that isn't going to make sense anymore. And so if that happens, you might see the US dollar weaken. And if that happens, that could impact the ability for some multinational companies to pay down their debt. A little bit more complicated analysis there, but it's something that you want to be considerate of. And then the other factor there would be higher interest rates. While that sounds a little far-fetched, you just never know what the impact of the U.S. dollar's credibility, standing is going to be when you have all these different narratives at play internationally. When you look at like how the U.S. has kicked out certain countries out of using the SWIFT system, how you've seen countries you've seen the European Union adopt an alternative to SWIFT, right? You had the German finance minister talking about that in August, September timeframe about how they are setting this up. Right, so that could be an impact that maybe people just don't trust the dollar as much, and as a result of that, we have to offer a higher interest rate in order to attract investors. So that could be a catalyst. These are narratives that have been going on for a while. They haven't played out because the Federal Reserve has just been so powerful. Central banks have been so powerful with having an influence in the market. But those are just considerations. Those could be reasons that you see the bond market have a little bit more volatility or fear. So prediction number 4 is going off of a trend that I've seen over the past few years, which is an increase in the quality of annuities that are being offered, or an increase in the functionality of annuities for retirees. And these aren't traditional variable annuities that I'm referring to. I think that the index annuity space has gotten very competitive over the past 4 or 5 years. And as a result of that, you've seen companies add bells and whistles, different features to their products to make them more competitive and to make them more attractive to retirees in particular. So what I mean by that is nowadays you're seeing some annuities that offer long-term care features. You're seeing some products that will give you liquidity, meaning that you can access a percentage of your money greater than what you may have been able to access in the past. There may be some bonus options there. I mean, there's a lot of different bells and whistles that these things have offered that I think make them worth at least looking at and considering as a part of your overall portfolio. And so for that reason, I think that you're going to continue in 2020 to see an innovation there in that space, and that could be favorable for retirees. Now, the final prediction that I have here for 2020 is going to be a continued innovation and continued improvement in long-term care and life insurance hybrids. And traditionally, long-term care insurance and life insurance have really been just two separate, distinct products. But now, with more folks retiring and more folks having seen their parents and the loved ones go through the long-term care situation, they understand the risk that it poses, and so they're more open to covering themselves. As a result of that, you're seeing insurance companies again innovate there. That's the most innovative picture I could find of a hybrid, by the way. But you're seeing insurance companies innovate their products, and as a result of that, one product in particular that I really like is it offers the ability to access the death benefit, right? The life insurance benefit before you die. So historically, you couldn't access the death benefit unless you had some power that most people don't know about. Because when you die, that money passes on to your family or to whoever you choose. And now, with some of the innovations that are coming out from different companies, what you're seeing is the ability to access that death benefit for chronic illness or a terminal illness. So chronic illness may be a situation where you're not going to be able to go back to work in full capacity. Maybe you had a stroke or a heart attack or something like that. And then a terminal illness would be something like cancer. So there are companies out there that are offering the ability to access those death benefits when you have a chronic or a terminal illness. And so they may allow you to access a percentage of that death benefit, and you can use that money for covering some of those long-term care needs, or maybe just living a fulfilling life during that period where you're having increased medical issues, expenses, etc. So I really like this option for a lot of retirees simply because the cost of a standalone long-term care insurance policy can sometimes be a little bit much, can be too expensive for a couple who's 55 years old, who's trying to catch up on their retirement savings to then go spend 5 figures a year on a standalone long-term care insurance policy. This might be a more attractive option for them because you can kind of cover two birds with one stone, right? Where I got one life insurance policy, it's going to cover me for my life insurance, but it could also cover me for a chronic or a terminal illness, right? For a potential long-term care need. When you factor in the potential value for the impact of the Secure Act, you got another reason to look at it. So there's a lot of good value that you may be able to get from looking at these products. And I think that what you're going to see is more companies will continue to offer this. It'll become a little bit more standard, and that's a huge win for retirees. So those are my predictions for 2020. I think that you're going to see the Federal Reserve have a bigger influence in markets. I think as a result of that, you're going to see a pullback in the markets. You'll also see some volatility in the bond market just as a result of a lot of different factors. I think that annuity companies recognize the risk, recognize the temperament in the economy, and folks who are getting ready to retire. As a result of that, they want to capture some of those investment dollars, so they're making annuities that are a little bit more attractive. And then I also think that those same insurance companies are catering to their marketplace by offering products that are more functional, more useful for them. So if you have found this helpful, let me know. Leave a comment below or share this video with a friend. And you can always get in touch with me here by going to GarciaSecureActs.com, registering for my training next Thursday at 7 p.m. Or you can reach out to me on Twitter or Facebook or LinkedIn. You can use those @FiduciaryFirst handles to reach me there. So thanks for tuning in, and I look forward to seeing you in the next video. Thanks a lot. Still figuring it out. Still figuring it out. And we're still figuring it out.